Now, has recent market activity been enough to turn a bear into a bull? My next guest, yes. Well, let's find out more from Dennis Hynes. He's the chief market strategist at RW Pressprich, and Dennis is a former futures trader at Bear Stearns. Dennis, good to have you with us on Bloomberg. So are you now an unrequited bull on the market? I mean, you heard the economic release today. Should we be a little concerned?
Well, I've turned to bullish, near term, not having to do with economics, but having to do with the Fed. And the argument was, after everything changed for me, the epiphany changed, when Mr. Bernanke said, this is an unusual period of uncertainty. Those two words put together meant that he was going to certainly provide whatever liquidity necessary to make sure that we avoid the double dip and to make sure we don't have a repeat of Japan's deflationary spiral.
So what else can the Federal Reserve do, though? Aren't interest rates at historic lows? What are they going to do? Stop paying interest on reserves that banks keep at the Fed?
I think Fed Chairman, St. Louis Fed Chairman James Bullish was his John the Baptist, and that means is that he was saying, hey, what we're going to do is this fellow had been an inflationary hawk for the longest time. Now all of a sudden he's saying, hey, deflation is the largest concern that we have, and he says let's not repeat what the Japanese did. So he is asking that you target the long end of the Treasury market. That's the 10-year sector, the 30-year sector.
Sort of flatten the curve a little bit.
It'll bring the curve to zero, and that turns out to be the one place that you can expect to see the benefits. Now, having economic problems is just what the doctor ordered from Mr. Bernanke. He knew and he expected to see this. This is not news to him. The problems we're having in the economy, he is just ready to pull the trigger, and he sent out his emissary, Mr. Bullock, to go out there and preach to the audience.
So how is he going to do that, though? How is he going to get the far end of the curve, the 10-year, the 30-year? How are they going to get those yields down?
The simple way to do it is just to buy it. When you buy securities, what you do is you reduce the yield and you increase the price. Now, I must say, for those brave souls who want to anticipate that, and I suggest that they are brave souls, if you had $100,000 and you wanted to participate in that, let's say that you bought into the argument that he's buying the 10s and he's buying the 30s, then go out there and buy 10-year on-the-run treasuries and hold it for the end of the year. Now, if in fact we go back and test the 206 level that we had with the March lows in 2009, that's on the 10-year, then he will be rewarded, or she will be rewarded handsomely, to the tune of 21%. That's
well, indeed, Gary Shilling, the economist of Gary Shilling and Company, that's precisely his argument. He's been buying the long end of the curve, and he says it's for capital appreciation purposes.
And he's absolutely correct, and he was early. And the early deserve the rich rewards. The late deserve, hopefully, the rich rewards. However, if in fact we are wrong with this, which I don't believe we are, but there's always the chance that rates can go higher. However, Mr. Bernanke will not do anything until he sees a flare-up of inflation. He has his own little indicators, which we are not privy to. And as long as he says rates will remain zero for an extended period of time, this is a good strategy.
And it's good for stocks.
It's excellent for stocks. It turns out to be you purchase stocks, you purchase bonds, you purchase gold. Why? Because there is true uncertainty here, and the currency of uncertainty is gold.
All right. Unusual uncertainty. A very good description of the market right now, and a very interesting way to participate. I want to thank you very much, Dennis Hynes, coming to us from RW Pressprich. Always insightful. Thank you very much.